Well, uncertainty is one of the big drivers of the economy. So what we see is when uncertainty goes up, firms and consumers tend to get cautious. So like if you're a company and you're going to invest in a new building or let's say a new shop and you're uncertain, you tend to pause. And if you're a consumer, you're maybe going to go out and buy that new car or new washing machine and you're uncertain, you pause. And as a result, high levels of uncertainty can slow down growth and lead to recession. So measuring it is really a way of predicting what's going to come ahead. It's called a leading indicator. How you measure uncertainty is not straightforward. It's really like, in the minds of managers and consumers, and you'd love to kind of, brain scan them, but without that, we have to look at indirect proxies. So the four we've looked at are stock markets. Are they volatile? So when the stock market's going up and down like that, typically uncertainty is kind of higher. We look at newspapers. So if the word uncertainty or uncertain is in newspapers a lot, typically it means it's something about uncertainty. We generally require it has to be in an article that also mentions the economy and other economic terms. So it's not just, it's uncertain who will win the World Cup, you don't want that triggering it. And then the third measure is we've been working on with the IMF, which was we've looked at the frequency of the word uncertainty in the Economist Intelligence Unit reports. So the Economist magazine produces these quarterly reports on every country around the world. So, everywhere from the US to, Australia to Ghana-Bissau to, Chad will have a report. And they're about 30 pages each. They're pretty standardized. And we look for how frequently the word uncertain comes up. And that turns out to work pretty well. And then the final measure is we actually go out and survey managers. We've surveyed tens of thousands of managers and we asked them to forecast sales and ask them for probability ranges and we can bring them out. All four of those measures, so finance, newspapers, the Economist reports and managers moved together. They all went up in the pandemic. Uncertainty was very high. They've fallen back down again. They've gone up with the Ukraine-Russian war, are falling back down again. They also show it used to be lower. So if you go back to, the more stable times of 2005, 2000, the 90s, they look very calm. In the last 15 years, we've had, I'd say, a series of bad luck. We had, the global financial crisis, followed by the European debt and banking crisis, and then we had Brexit, Trump, pandemic, and then the Ukraine war, and that's just generated a whole era of higher uncertainty. Well, it's hard to be precise, but I should say it's hard to be that certain, but I would say the two key measures that we can look back over time, the newspaper measure and the word uncertainty index, both suggest right now globally and for Sweden, we're about twice the long run average. So both of those indices we normalized to be 100 from 1990 to 2010. So think of that as the kind of longer run. They're now, rather than 100, they're both about 200, 220. So they were higher. So if you go to the pandemic, just, things go up and down. The pandemic's 300, so like 3 times long run average. It's dropped back down to 200. It would be lower, but of course, while the pandemic's ending, the Russia-Ukraine war has kept it high. Well, forecasting uncertainty is very hard. It's kind of like forecasting the weather. You can make a good forecast a day out. It's very hard to make a forecast a month out. And often there's this thing called the Anna Karenina theory of uncertainty. So Anna Karenina is that famous book by Tolstoy, and the first sentence says happy families are all the same, unhappy families are all different. They're all unhappy in their own way. So uncertainty shocks are like that. So if you look back, uncertainty shocks are all different and hard to predict. So going back in history, things like Cuban Missile Crisis, assassination of JFK, more recently 9/11, the pandemic, wars, invasions, Gulf War. So these things on average happen about once every 8 years. So my prediction would be some bad, nasty event will happen in the next 4 or 5 years on average. What it will be, I don't know. So there are lots of things it could be. I mean, it could be, China invades Taiwan. It could be an assassination of a major European leader. It could be a hacking epidemic. It could be an earthquake, hits the whole of California. There are lots of things that have a very low probability of happening. If one of them arises, we'll see a big increase in uncertainty. The best, it's hard to forecast them. The best thing to do is at least be aware. It's kind of like fires in your house. You don't want them. You do your best to prevent them. They do occasionally break out, and so you're best being prepared in case they happen. So investment's very sensitive to uncertainty shocks. So the reason is if you're a company, you're looking ahead to the future. Let's say you're going to build a new piece of equipment or build a new outlet if you're a retailer, say, or build a new building if you're a hospital. If you're really uncertain, it's very easy to make a mistake. So imagine I'm a retailer and I'm like, well, I might expand onto this high street. But if you're uncertain, you could find that you've expanded only for no traffic to go through or business conditions to change, and you're left with this horrible investment. So uncertainty makes people cautious, and it makes firms cautious, it makes individuals cautious. And so high uncertainty reduces investment, and so that's why it slows down growth. It's hard to reduce your exposure because these are natural events. The best ways to build resilience is we wrote something up, a summary in Harvard Business Review a year ago saying the 3 things to do for firms and for countries is 1, pay attention to news and current events. So an increasing amount of uncertainty looks like it's political in nature. Think Brexit, think Trump. So, watch the news, pay attention so at least you're forewarned. Secondly, pay a little bit for flexibility. See, the idea is, rent rather than buy, lease for shorter rather than longer runs, rent staff, have shorter term contracts. For example, for companies, if you're taking out a new office space, rather than sign up for 10 years, sign up for 5. It's more expensive in the short run, but it gives you more flexibility. And then finally, it's contingency plans. So during the pandemic, I've talked to several companies that had contingency plans. They'd set aside management time to think about things like what happens if a fire burns the headquarters down, or what happens if our network gets virused and we have to close it down. Now the pandemic happened. Those plans weren't perfectly set up for the pandemic, but some of them were useful. So what they could do is more rapidly deal with the situation. And so contingency planning is the kind of thing executives need to do. You maybe spend half a day a year doing it, but it pays off whenever there's that disaster.